So Nate, tell me about your history and how you got involved in real estate and doing real estate transactions.
Let's not talk about that. Let's talk about not our history, but let's talk about real estate itself. Because you know what, so much.
You're driving the train.
All right, drive the train. I don't want to talk about what I've done in the legal world because I never want somebody to be calling me about a real estate transaction. I want them to call you. I want them to call somebody. You know what?
What do you want me to ask you about?
Whatever you want. I will happily gab about anything.
Except how you got into real estate.
I will tell you exactly how I got into real estate. And that was actually my first legal job as an attorney. No, I lied. Second legal job. Excuse me, I just totally spit all over you.
Like hacked a Luke over here.
Completely. So my first job as an attorney, I worked for a private equity firm. And we had some little real estate deals that were going on. And I learned a lot about contracts and whatnot, but that was mainly business. My second position was at one of the largest transactional law firms in the state of Nevada. And I was exclusively working with real estate transactions at that point. A lot of it was like raw land syndications, land banking, or development opportunities. It always involved investors coming to the table, and I was always kind of part of the closing process. And that continued very well until about a year into it. I was bringing in a lot of clients. It kind of made sense to jump ship. And that's where in 2007 I did jump ship, started Dodson Legal Group, and we continued to really 100% focus on contracts, real estate, and investments. And that was really, that was the entire focus right up until the wonderful time of the Great Recession of 2008, 2009, which all of a sudden, all of these real estate investments that I had represented and worked with in the state of Nevada, or it was either Nevada or Phoenix, went belly up. When the value of land goes down 75%, it is very difficult to maintain any real estate. So that happened, and around that time I had been doing syndications and everything. Well, the capital groups that were funding these opportunities, they didn't stop being in business. They just changed what they were focusing on. And this is where it got kind of interesting. I connected with a number of groups that were heavily focused in investing in multifamily. And the way that Securities works, it's federal law, so I was able to do it anywhere in the country. And you know what? I had a great run at it, acquired 4,000 to 5,000 multifamily apartment units. That I was actually part of the general partnership group, part of the sponsorship. So that was, we would take care of the legal work, we would take care of the securities, we would do what we have to do to help with the transactions, and I could as a partner and really involved. And that lasted right up until about the time that I moved to Texas, which, so that was between 2009 to maybe 2013, 2014. I had a second child in 2012, and in 2013, at that point, because of how my business had come together, I was just traveling nonstop. So I made the big agreement with my lovely wife, Jasmine. If we moved to Texas, I promised to quit travel. that was kind of the end of me doing a lot of the kind of GP sponsorship that I was participating with.
Mm-hmm.
But when we moved to Texas, it really continued on, and it does to this day. That just represented a lot of it started with apartments, and it's just kind of grown to we're representing a lot of REITs. Well, REITs in terms of a real estate fund to acquire real estate.
Well, the question I was going to ask you is just how do you explain the just tremendous growth in real estate, even through, especially multifamily, even through having almost 2 years of an eviction moratorium? Like, tenants literally don't have to pay rent, and yet somehow these properties, whose value is based on their income, seem to just thrive and grow and trade for higher and higher and higher dollar amounts.
Well, I kind of have a terrifying explanation, and it is the growth of the money supply. And really where the money supply is growing and who was getting control of it. Because, up through until the pandemic started in 2020, things were just going well. Profitability across the board was doing fantastic. Then the pandemic started and everybody freaked out. And just kind of the market died for a short time period.
Yeah, I think we slowed down for about 2 months.
I was thinking it was probably April to about August.
I think we picked it before then. I'd have to look, but I feel like when everything shut down, like March-ish, we had a bunch of deals push out, we had some things go slow, we had fewer retentions, and then, yeah, somewhere summertime, early summer, I think, just all of a sudden we're the busiest we've ever been. And I'm like, how is this even possible?
I kind of explain it as we didn't lose any business. It just got delayed, and then we had to catch up. But no, I think that with all of the helpful programs from the federal government to make sure that actually not the people that were receiving the $1,200 checks, but the business owners that were receiving hundreds of thousands of dollars from the federal government that didn't have to get paid back, well, that was just cash flow for them to invest into hard assets or the stock market. So both the stock market as well as real estate, in a time that things were seemingly should be falling apart, was taking off like crazy. And I think that's exactly what happened in the real estate world. I don't necessarily think we're done with it, because even still, the amount of money that is getting issued and the growth of the money supply, the M2 money supply, it's still just gigantic what's happening. Even though the Treasury Department is reducing its balance sheet, people keep spending money, and so the value keeps being there. And now we're finally getting hit with that inflation issue. But honestly, I'm not terribly concerned when it comes to real estate, because of the inflation of the rents are going up even faster.
So what do you see happening in, multifamily, right? You can raise rents yearly in most cases. What about commercial, where you've got these, rents locked in for 10 years, maybe with a 3% increase or something, sometimes no increase? What do you see happening to commercial real estate?
I think everything will be fine, so long as you can, for a 10-year lease, you're also getting 10-year debt, where you're getting your financing to meet the revenues of what's going on. And I think you're going to see once you have a lease in place, yeah, people want to keep it. But once those leases go away, the rents go sky high, and those property values are going to go sky high. So I think on the commercial side, it is becoming more of a long-term play, but I think ultimately you're going to have such a massive increase of value at that later date that you're just going to see kind of this weird curve of like values growing slow, shoot up in about 10 years. You'll probably get a little hit in about 4 or 5 years, but when you talk about the commercial leases, yeah, they're longer, they're 5 years or 10 years. There may be extensions worked into those, but also a lot of those tenants signed a long time ago. So we've been opening up businesses, new offices, new things for a long time now. So you do constantly have that, just at a lesser extent, when leases are coming up and the rents shoot up as the leases are up. I know a lot of commercial leases would have extensions that, it resets to the market rates. And all you got to do is reset to a market rate that is looking at what the market should be. And it really, those long-term leases may not protect the tenants as much as they think it should.
You're not expecting a lot of Spirit Halloween stores to be opening up next year?
You know what? There's always tendencies, so I always think that Spirit Halloween has a home.
It's my favorite store, man. What's the craziest thing that's happened to you in the last year?
Holy hell. Let's see here. This has been a pretty boring year. I mean, we keep hiring, we keep growing, we keep expanding the base of our business. I think the craziest thing has been the amount of education that I know I've gotten. I think you've gotten as well.
The amount of money we've spent on education, holy crap.
Forget about the law school. I think we're pretty close to at least a full ride of law school at this point, just with the educational expenses. But I see it as it is some value that we can transmit to our clients as well.
Well, just starting to go to mastermind groups and starting to meet people who are operating at a much higher level than I am, and kind of the people that are leaving the roadmap, for us, or the success leaves clues, like Tony Robbins says, like kind of following. What I'm discovering is that these people who have 10, 20, $50 million businesses are still paying a ton of money to learn from mentors who are further ahead, who are at $100,000 businesses or whatever, or bigger than them. And so like that kind of clued me in on the importance of hiring mentors and educators and taking classes and reading books and just constantly like absorbing and staying humble and open to new ideas and new ways of doing things, because I got so much to learn, dude, and it's never going to stop. And so now paying $25,000 for 2 days of a mastermind was I only made 24 my first year out of college, so to pay
gone in 2 days.
To pay that literally to be in like a 2-day question and answer session with a billionaire was that's a different world, man. That's
Do you think it was money well spent?
Absolutely. I think I'm going to get that value back 10 times for sure.
Well, I'll be honest about something. I think that everything that we've done and spent in these masterminds and education and all this, honestly, for your change of mindset, to go from that technician to more entrepreneurial, best money ever could be spent.
It's a huge paradigm shift, and it's one that I knew I needed to go through, but knowing you need to make the shift and actually making the shift is two very different exercises. And I'm still going through this. It's hard. I'm still working on letting go of a lot of the work.
When you were growing up, how did your parents teach you that this is how you live well? Like, and I'm talking like financially or work-wise.
It was the traditional go to school, get good grades, go to college, get a good degree, find a good job, work hard, save your money in a 401k, all the traditional like steps that you're taught to make you successful. And I figured out pretty quick that wasn't for me, and I didn't know what was for me, but I knew like I don't want to just be stuck in a job, man. Forget this stuff. And I played in bands in years, and did crazy stuff like that.
Hippie through and through.
Hippie through and through. You know what? I tried growing up. I cut my hair when I went to law school, and the couple years that I was in big law, I had my hair real short and wore my suit and stuff. And God, I just couldn't do it. It was a mask, man. It was not mine. So I just had to be like, forget it. I don't care if I can't, get a cushy job with my hair long. It doesn't feel right. I don't feel like I'm in my own skin. So, but
how do you feel today?
I feel great.
That's awesome.
I feel like myself, and that's really cool. I don't have to worry about fitting in with a bunch of corporate attorneys and whatever. Like, they were all great people, but like I was not part of the crew. It wasn't my family over there. But anyway, I think like even just kind of on a broader scale, we're learning that model that may have worked in the 50s, 60s, 70s, 80s doesn't work so well. And people with degrees are not doing that much better than people without degrees. And the 401ks are not growing the way we were promised they would grow. And people are kind of discovering that like, okay, maybe the economy works a little different than we were taught. Maybe investing in our thoughts about retirement need to be shifted a little bit. And the idea of just saving a ton of money and then slowly spending it down is not how you retire.
How do you retire?
In the way I was taught, and through the education groups I've been involved in, you retire through cash flow. You retire through passive monthly or quarterly income that exceeds your bills. And it's, you think about we thought of retirement as having a big bucket full of money. You can imagine maybe a bucket full of water, and you try to
pop a hole in it.
Pop a hole in it, and and nourish yourself and hope you don't run out of water, right? But it's better to have a faucet.
Mm-hmm.
And as long as because you can just turn the faucet on and it'll just keep running. It doesn't matter. You don't have to worry about the size of the bucket or how much you have. You just have to worry that what's coming in exceeds what's going out. So that more cash flow mindset of retirement versus saving for retirement, I think, is an important shift in the way we need to think about how we're going to handle money going forward.
So I love that. And now to bring it back to what we're doing today, and I feel like we're helping the world accomplish exactly that. But to focus on actually your clients, how would you say we're doing that for our clients?
I think most of our clients are involved in cash flow businesses, cash flowing real estate, rental real estate, whether it's commercial, multifamily, single family, Airbnb. It's the same idea of they are chasing residual income. And they're investors too. And their investors are people like me who don't want to be running properties. I put my money into deals, and those deals pay me a check every quarter. Or they refinance and pay me a really big check, but most of the time it's just a nice trickle, and each investment gives me another trickle. And working my way towards having all my bills paid by that. So
I've am slowly getting to the place that I'm just realizing that, same thing you're talking about. The old ways of doing it, gone. It just doesn't work anymore. Even the investors that are able to invest in this, well, they're to a large extent the beneficiaries of this way that did work and no longer does. I think everybody should be focused on that cash flow, but actually becoming an active investor, actively creating these income streams. And once you're in there and you can actively create the cash flow, then that's where the entrepreneurship kicks in to hire your way out of it, and now it's passive. Now you can retire.
Right.
Quite literally, people can retire in a few years if they do it right nowadays.
Mm-hmm.
And it's not from the 401ks or the IRAs.
And it's not necessarily from having a ton of money to start with. And I don't know if you've ever played Cash Flow, the Robert Kiyosaki board game. So it's a board game. It's kind of like Monopoly, except you have an actual financial form, a balance sheet, income statement, and you have a job that pays you a salary, and you have expenses, and you go around and you have opportunities to make investments. And as you make the investments and build your cash flow, you can escape the rat race once your cash flow exceeds your expenses, right?
Okay.
So the interesting thing about the game is everyone starts with a different career. So you might be an engineer, you might be an airline pilot, you have really high salary, or you might be a janitor, you might be a teacher with a really low salary. And I've played this game a ton because it's a great just educational mindset tool, and it's easier to retire from cash flow when you have those smaller incomes. Because people who are living on smaller incomes are also living on smaller expenses, and it's a much lower threshold to surpass. You can surpass it with just a handful of single-family houses, whereas a doctor needs to have apartments and a bunch of really high cash flow things in order to escape the rat race. So it's another paradigm shift about what is possible as far as retirement goes, and if you know how to get into deals, how to make deals, especially if you can make deals without a lot of money out of your pocket, it really levels the playing field of being able to escape the rat race and actually retire.
So I'll be honest with you. I did pretty well with the various deals that I've been involved with, and I've got the cash flow that I could not be here today. Kind of fun because I choose to be here, which is a wonderful feeling unto itself. But I feel like my biggest job now is to help others have that same experience where their cash flow allows them to have the financial independence to choose what they want to do. And hopefully those people still choose to be productive, still choose to do more. But if they want to go and golf with their life, great. You should be able to do that too.
Well, we've got a lot of clients too who are even retired before they come to us. They may have just retired because they bought 10 or 20 single family houses, and then they now I've got time. So now I can focus on doing these big multifamily deals or commercial deals. I can make a ton more money, and I can bring in other investors and help them get to the point where they retire. And so there's just a big win-win altogether when these deals are put together.
I love it. And when you're putting together a deal, where are people finding their investors?
So my personal book of business and the clients that I bring in myself tend to come from one or two real estate education groups. And those groups are amazing because they create these networks where investors can exchange ideas and learn together, and they're all like-minded. And then a deal sponsor can present them with a deal. All the investors are educated, they know how it works, so they can evaluate the deal, invest in it. And so, the deal sponsors in these groups have a very easy time raising money because they have an audience that already knows exactly what they're doing. There's no need for additional education or anything. Just, here's my deal, here's the numbers, do you want it? And they're all like, yes, come in. So Those are wonderful organizations to get involved with.
Love it. And I guess most of the people that I deal with, really, they plan their own marketing campaigns. They are growing their own network. I gotta say, I think that the guys that I'm dealing with have it much rougher than being a part of that group, but at the same time, they'll tend to get a bigger share of kind of the sponsorship and the back ends compared to those groups that are a little bit more defined about what you can, how you structure opportunities. So, forecasting. Where do you think this market's gonna go?
I tell you what, I am the absolute worst person in the universe to forecast the market. I have been waiting in the wings since 2014 for the big crash so that I could get in on some cheap real estate, and that has not worked out. So I will not purport to know. I know stuff's going to shift. I don't know how. I don't know what industries are going to be affected in what ways. And I would be a fool if I went out on a limb and tried to say I knew anything. So,
fair enough. Well, not financial advice, but I do think that real estate is going to continue to do well. I think it's crazy the cap rate that people are buying properties at. However, and a cap rate is, what is it, cash flow divided by purchase price or something like that, around there. To figure out what your capital rate of return is, your cash on cash. And it's not even cash on cash because that would include the debt. But if you were buying an apartment complex at a 3% cap rate and you're getting financing at 5%, are you making any money?
I've seen deals where that's happened, where your cap rate is lower than your financing. It seems to me you're better off doing all cash, frankly. And I think the only reason I could see, and maybe you have another idea, the only reason I could see to do that is if you can't raise that much capital.
See, and I think there's still a benefit to leverage, even if it creates that negative cash flow situation. At a 3% cap rate, a 5% loan, cash flow is not going to the equity side. And the equity side maybe have to be 35 or 40% to make up for the debt. But when you have inflation going crazy and rents going up even faster, I think you gotta add all that up to realize that, oh, if rents are going up 15%, and I'm paying 7%, it's actually better now than it ever was before. Like, it really can make a lot of sense. And I think that's not gonna stop until somebody figures out what to do about inflation. And that's like telling the government to quit spending money. Good luck with that.
Well, the cap rate is like an expected percent return. And so, if you're factoring into your calculation future growth in rent, you're basically assuming a higher cap rate than what is stated. And so maybe okay, it's a 3 cap based on the T12 or the T3, the trailing financials. But we think in a year from now, this is really going to be spitting off 7, and now 7 makes sense with like a 4 or 5% loan. So.
And I think you're finally like nailing the why we're seeing so many deals still happening at cap rates that just a few years ago would never make sense. But there's been a paradigm shift and a market shift. Mm-hmm. And all of a sudden it does make sense, even if literally 3 years ago it'd be like, really? Is that what you're thinking?
Well, and I've talked to some lenders, and they, traditionally you would look at a deal and you'd look at the trailing 12 months financials as your metric of what's the financial health of this complex. Well, then recently that shifted to only looking at the last 3 months because things have changed so quickly. So we're not even going to look at those other 9 months are just old data now. And then I'm even hearing about some deals where they're not even looking at the trailing 3 months, they're looking at pro forma, they're looking at just projected income and basing their assumptions behind their loan, their underwriting, on the trend of the rents, not the historical rents. And that's a really interesting shift.
That scares me. Because that reminds me of back in the 2007-ish, 8.
Real estate will never go down.
Real estate will never go down, and you know what? Because it'll never go down, go ahead and borrow 125% of the value. Not paying attention to the past, that actually scares me to death.
I mean, they're paying attention to the past only to the extent that it shows a trajectory. And I think they're assuming that trajectory will continue for at least a certain amount of time in the future.
Which I think that's true to an extent.
I hope they're right.
I hope that they're not right. I hope that levels off. But the fact is that it won't. And I don't know when it ever will. But hey, let's enjoy the market while the market is good.
For sure. Or champagne clean.